We want to close the seminar today with a discussion on the just published sustainability rating proposal. To do so, we have with us Jean-Christophe Nicaise Chateau, who is a desk officer in Sven Gendner's unit, Freudian slip, but really was at the heart of working on this file, who will spend a bit of time talking us through the main elements. Thanks very much, Jean-Christophe, for making the time. It must have been incredibly hard weeks and months for you writing this text. We've got Neil Akers, who's the Global Head of Regulatory Affairs at MSCI. And if you don't know MSCI, you should really get to know it because it's one of the most prominent providers of sustainability ratings in the market. And we have Dennis Haensel with us, Global Head of ESG Investment Solutions and ESG Advisory at DWS, which is the fund management arm of Deutsche Bank. And I think it's interesting to have the user perspective here as well. So thanks very much for the three of you for spending the next 40 minutes or so with us. But I think, Jean-Christophe, I first pass over to you to talk us through the proposal and your thinking behind the proposal, because we can all read the text, but sometimes it's good to hear a bit more the kind of thought process that led you to the text as it is. Thanks very much indeed. And for this, I think we've got some slides which the technical team is showing as well. But over to you, Jean-Christophe.
Thank you, Nickolas, and good afternoon, everyone. I'm really happy and thank you for the opportunity to present to you the initiative today. We have a number of slides to share with you, to take you through a bit of a journey. Maybe next slide, please. It's been a long journey. So this Commission proposal that came out last week, we all started back with the first action plan on sustainable finance in 2018, where at the very beginning we were looking at all ESG rating, data, and other assessment tools that are provided by specialized providers. And then we have done a number of consultation over the years. We have also studied an external study in 2019, 2020. And then that led up to the proposal that was adopted last week. It's very important to say that all of the signals that we have had over the years have been for the need for more transparency, more clarity, more integrity over the provision of ESG ratings by specialized ESG rating providers. And the call for intervention has been coming back over and over the years. It was really important for us as part of the last, I would say, milestone under this current commission to come up with an action in this area in order to mind the gap and the last obstacles with the achieving of the sustainable finance agenda. Next slide, please. Maybe I will start off by telling you a bit about the scope, because once again, the scope comes from the origins and for the history of the file. So as I had mentioned, we started looking first at ratings, data, and other assessment tool providers, but the vast majority of the feedbacks relating to the issues, the shortcomings with the functioning of the markets came in relation to ratings. Ratings in the sense of an opinion that is provided by the rating provider, but also an analyst, but also ratings that include scores. So not only when you have a rating analyst in the process, but also where you have computerized and other algorithmic information that sets the frame. What the scope is not about of the Commission proposal is first the provision of other assessment tools, first and foremost ESG data providers that are excluded from the scope of the Commission proposal. Here, a number of reasons behind this. There is a lot of work that is ongoing at European level, at international level, with the CSRD, with the ISSB, and the development of European sustainability reporting standards, where we consider that there will be better quality, better comparable data that will help the market address a number of shortcomings there. But also the availability of information via the European Single Access Point that also reached a trilogue agreement between the co-legislators just a few weeks back. Secondly, out of scope of this of the Commission proposal are in-house ratings, so in-house scores that are developed by investors, by banks, by benchmark administrators. The reason there being that the use is very different to those from ESG rating, specialized ESG rating providers. They are used only for in-house investment strategies, considerations, and they are not sold or marketed to the outside world. Therefore, also the relationship with conflict of interest are not the same. So they are excluded also from the scope of this initiative. Next slide, please. So for the definition of ESG ratings, as I had already a bit alluded before, we have taken also, as you mentioned before, the need for international coherence also in that area. As a basis, the definition from IOSCO, from their set of recommendations published in November 2021, where it was really important to have their definition which is as clear as possible, as broad as possible, but at the same time as targeted as possible. The need there to target ratings or scores in the two forms, as I had mentioned before, where you have a rating analyst or where it follows a computer or any other algorithmic information, or any mix of both of the two aspects should be also captured in scope. Next slide, please. On the key elements of the initiative, I think it's important to start off by the big change also with the market here will be for ESG rating providers and the need to be authorized, authorization that will be undergone by ESMA at European level in order to be able to offer the services in the Union. The authorization, but also supervision will be done by ESMA at European level. Why? Because of the expertise that ESMA has gathered over the years, because also of the role that ESMA has in relation with credit rating agencies, for example, with benchmarks, with green bonds, and the fact that because of the nature of the market and the cross-border nature, it is important to ensure level playing field and approach in that area. So this is also why ESMA was chosen as the sole authorizer and supervisor of ESG ratings. Coming up to the second point, crucial one, as I had mentioned before, the two objectives also coming from all the outreach and exchanges we've had with the market is more transparency on the ratings and more integrity on ESG rating activities. And there, especially on conflict of interest, a number of concerns have been brought to our attention over the years, especially where ESG rating providers would be offering at the same time audit services, consulting services, credit ratings, benchmarks, where there could be possibly some conflict of interest with their activities. So the Commission proposal provides for the need for ESG rating activities to be separated from other activities in the sense of a legal entity separation. Crucial element here, we do not preclude groups in the group structure to have benchmarks provided together with ratings, with audit, with consulting services, etc. in the group. But for the provision of ratings themselves, it needs to be in a separate legal entity to the rest. So I feel that this is important because also to recognize the nature of the market, the specific of the market. A lot of the providers, also including Neil here today, offer a number of services, and we do not want to be jeopardizing the structure of the market or to coming up with some big bang that would be important there. But also we have seen that the separation of businesses and legal entities is already a trend, if I may say, or happening in the market. So this is just to strengthen and solidify that here. Third point, importantly, the Commission proposal provides for proportionate and principle-based organizational requirements. Proportionate and principle-based because of the need to allow the market to continue to innovate, to thrive, to develop. It is a young market, although it's been work ongoing for a number of years, but it's still very new compared to other financial services market, and there is a need to allow for that innovation to continue. Therefore, the Commission proposal provides for a number of objectives to be reached, but the means in a way where the providers organize themselves internally, that's up to them as long as the objectives are there. So providers will need to have rules and procedure in place to ensure that there is no conflict of interest in relation to the rating analyst, in relation to the other methods, but it is more for them to organize to achieve the objectives. And this is also in particular true for smaller providers, where it may be even more challenging. So having that objective in mind is really important there. The fourth point is really on that transparency element. So again, integrity, transparency. And there it is important to give that information to the markets about what ratings are about. It has been a lot of orientation. We have seen a lot of concerns or scandals here and there about the fact that the ratings may in fact be about financial risk and not about impact, while some users were thinking that it was actually about impact and not about financial risk, or it was a mix of both. And then there is a need to bring more clarity to the market. In that sense, also, again, in order to recognize the structure of the market, which is really important here in the Commission way of coming up with that proposal, the transparency element will be twofold. So more general information on the ratings, what they are they about environment, about social, about governance, a mix of all? Are they about impact? Are they about risk? Are they looking at biodiversity? Are they looking at social elements? So that will be for the general public. And then users of the ratings. So in order to recognize the user pay model, which is predominant in the market, not issuer pay like credit ratings, then those that are users will be getting additional information, more detailed information about the weightings, about the methodology, about some more granular detail about a lot of information there. And also that information will be also given to rated entities, where sometimes, at first they may not know even that they are rated. They may discover that or have some team in place to check on this, but also they will be able to understand how they are rated. Last but not least, always a challenging point, because there is a limit to where you come in terms of contractual relationships between market players. It's about more transparency on fees. So a lot of concerns or just a lot of comments have come around fees and how the information is shared between also providers and users. And therefore, there is some high-level information for the providers to inform on the fees, how they are constructed, but more general information, but also, and in particular, the need for them to be fair, reasonable, and non-discriminatory. So the FRAND principle, which is important also in EU law and which is enshrined in that Commission proposal. And there would be a role for FISMA also to check that all of these principles are well applied in practice. Next slide, please. Key one, another key one. I'm sorry, all our key ones, but this is where we are now. But I think it's also very important, especially for those that may be providers in the room and also listening. The Commission proposal, I repeat myself, but it's really important, is about transparency and integrity. It is not about telling what providers need to do. It is not about telling them you have to include this framework, this reporting data, this element for your construction of the rating. Users, investors, everyone has told us that they very much value the diversity, but they just want to know what the ratings are about. So the regulation, the proposal does not provide for any methodology, intervention, or requirements with regard to ratings. I think this is really important. It's about the objective, and as mentioned here on the first point, rating need to be rigorous, systematic, continuous, objective. But how they are constructed in terms of the content is up to the providers. Next slide, please. Third country providers, also as you had mentioned before, thank you for that. The market of ESG rating providers is in the sense that from what ESMA also told us, there is about 59 providers that are offering their services in the Union. The vast majority are smaller providers, but there's a few large providers, and a few large providers are also mainly located outside of the Union. So there needs to be some ways to allow for a continuation of activities and services in the Union. And there we have followed the triptych approach, I would say, from a mix of credit rating agency regulation, benchmark regulation, green bond standard, allowing for decision, equivalence decision from the Commission, where we consider that the regulatory framework is matching that of in the Union. Endorsement by ESMA for ratings developed outside the Union, but by endorsement of one that is already authorized in the Union, in the same group. So this takes from the credit rating agency regulation, actually, where the benchmark regulation doesn't specify that element. It can be anyone else, but in practice, no one else has done it that way. So that's why also we have approached this. And finally, recognition for smaller providers, in order to give them the possibility to offer also the services with less of potential impact. And we need to allow, because also that's what we have seen with the benchmarks. Endorsement is used by the larger providers, recognition is used by the smaller providers. And recognition allows for that with the need to have legal representative in the Union, and then has less, of course, implication than others. Next slide, please. And I think this is the last slide for me. Again, coming back on what I mentioned before, the vast majority of the market is composed of small ESG rating providers, specialized small ESG rating providers within the ES or G factors. It is important to ensure, in particular for them, first, they may be aware, they may not even be aware that the regulatory framework is coming. They may not have a lot of means, first, especially to operate. So it's important to allow for them to continue to operate or even to enter the market. And that innovation needs to also come and comes from the smaller providers. So the Commission proposal provides for a number of mitigating measures of potential impact of the regulation around transitional period for them to be authorized, so longer time. Also in terms of supervisory fees, so because of the fact of the authorization and supervision, ESMA is entitled to charge supervisory fees to the providers. And the supervisory fees will be adapted to the size of the providers. To, for example, first, it's not a larger percentage, but there will be still a very big difference between the smaller one to the larger one. It's important there, again, for the cost not to have too much of an impact on the operations. We also know, and this is the third point, sorry, that ESMA operates in a risk-based approach, so looking in supervision, looking at the larger providers that may have more impact on financial markets and single markets. And finally, and this comes from the credit rating agency regulation, there is a possibility for ESMA to exempt from some organizational requirements smaller providers, where it considers, based on some assessment and analysis, that there may not need to be all them in place because of the way that they are organized. So I think this is it for me. Maybe next slide, just to be sure. Yes. Thank you very much again for the opportunity today. I'm very much looking forward to our exchange, but also any questions you may have. It's been a long journey. We are almost there. Again, it's a Commission proposal. It will undergo discussion, negotiation in Council and the Parliament that will start under the Spanish presidency in 2 to 3 weeks' time. We are very much hoping to conclude the file under this Commission mandate and Parliament, knowing that the Commission and the Parliament are coming to an end mid of next year with their mandate. So it will be challenging, but we hope we can get there. Thank you very much for your attention.
Thank you very much indeed, Jean-Christophe. I think at least speaking to the Spanish, they've got a lot on their plate, but they've indicated that they want to prioritize this file. I think they already have an accounts working group, I think on the 2nd of July. So an interesting dynamic, meaning in their second day in. So good luck with you on that. And even if one's read the text, there's at least 2 things I picked up on in your presentation that had not been fully clear to me from the drafting of the text. One being the actual separation point, because it wasn't clear to me that you were looking for legal separation. I wasn't clear from the text that was so explicit. And the second one around pricing, where you mentioned FRAND explicitly, and I had not heard that before. Just remind everybody in the audience, there's the Q&A function. If you've got questions to Jean-Christophe and the panelists, please take advantage of that. But that, Neil, I would like to pass over to you. Neil, we've had the joy or not, you can discuss how much sarcasm is in there, of going through the credit rating agency regulation, the benchmark regulation, and now we've got the sustainability rating regulation in draft. I'd be interested in your initial reading of the text and reactions to it. Thank you.
Great. Thank you, Nick, for the invitation to speak at the event again. It's really good to be with Afore again this afternoon, and great pleasure, of course, to be with Jean-Christophe and Dennis, as well as key partners, I think, on this sustainable finance journey rather than adversaries. So very happy to be with you on the panel together. I think from an MSCI perspective, at least, this has not been something that has come out of the blue. I think we've certainly been expecting this. The Commission has been very good, Jean-Christophe and team, in signposting that this has been on its way. since the targeted consultation. And so we're in the process of assessing what this means for us and what it means for the broader industry. But I suppose we had sort of three main high-level points which I wanted to sort of talk through today, and then as we go through, no doubt some more will arise. But the first one really was to echo what Jean-Christophe said in one of his slides, was we were very, very pleased with the Commission's approach to protect the independence of rating providers. I think for all those sort of policy geeks that are out there who study, maybe Nick, maybe it's just you and I, that study ratings policy and the development of ratings policy, one of the cornerstones of any policy development is really the protection of independence. And that's important because investors want to be able to know when they're using a particular rating that rating genuinely reflects the truly held opinion of that rating provider, and that there's no ratings inflation or deflation because of some intervention from whether it be a user, an issuer, or a regulator. And so that protection that's offered in the proposal is very much to be welcomed. But in addition to that, and on the same line, is the diversity of opinion is also certainly something that's to be welcomed, and that's important because, again, we're in a stage where ESG is still at its infancy, and different users want different things. There are providers like us who have products that speak to financial risk caused by ESG factors. There's others, including ourselves, that have products that speak to the impact, right? What is the impact of the company on its environment or its social infrastructure? And so putting those together and having those options available for not only us, but also users to use is something that's very important. There's no one correct view of what ESG is, and really allowing investors to select from what's available to them in the confidence that this is all under a regulatory framework is certainly something that is to be welcomed. So we did want to point that out as an important piece of the legislative proposal. Secondly, and sort of drawing on a point that I raised earlier, was very much the fact that this is a new industry, right? We very easily fall back on, again, Nick, what you mentioned at the beginning is, well, is this something that's been going for the last sort of 100 years and that is well developed, and this is just housekeeping to clean sort of conduct up? Not the case. We're very much on step one of our sort of 100-year-old journey, and so trying to find a balance of a legislative proposal that gives confidence to the market in terms of how ratings are assigned, but balances that with the need for innovation is the sort of magical sort of pathway that we need to find. I think from our perspective, we maybe have a slightly different view to Jean-Christophe in terms of the principles-based nature of the proposal. We do think it goes further than perhaps needed to achieve those objectives. I think the principles are solid and sound in terms of transparency and conflicts of interest management, and we think those can be achieved in a slightly more balanced way. The effect of this proposal is going to mean, organizational restructure, is going to mean compliance infrastructure changes, is going to mean regulatory operations development, and of course fees to FISMA, which does, at the end of the day, result in an increase in cost, not only for us, but for the broader industry. And so it's trying to find that balance of how to make that work, how to bring in third country regimes without overweighting it and causing the market either to freeze and not be able to really innovate by the introduction or with the introduction of new players. And so we're hopeful that during the co-legislative process that will be recognized, and where there is an opportunity to focus on the principles rather than some of the detail, I think would be to the benefit of the market more broadly. Ultimately, what you want to have in the market is encouraging long-term players, right? You want players who are in there for the long haul, not there to make sort of a quick innovative solution and then disappear, but really are there to build on that and to effectively lead to sort of a full competitive environment. And I think that's something hopefully that we can try and encourage through the final legislation. The third point is again something that we again recognize that we will be regulated, and we think it's certainly important for the industry to be in that space. We will certainly meet whatever minimum requirements are set at the end of the day and go further than that, just in terms of the nature of how we operate and how we've done previously in other sectors. But we do so on the basis and on the understanding that this will be a fair market, and so we very much again welcome the points made that, look, if you are conducting the same activity, i.e. you are publishing ratings for public consumption on a consistent basis, that you are subject to the regulation regardless of who you are as an entity. And I think if we set the regulation as opposed to companies that are specifically targeted, but rather the activity that is intended to be captured, this will be a regulation that then lasts without any need for intervention in terms of further amendments to the proposal. So we're very appreciative of same activity, same risk coming through in what's being put forward, and we look forward to working with that proposal going forward. Nick, that was generally, I think, the 3 points that I wanted to raise within the time space that you allocated. But I did, before I just depart, wanted to specifically thank Jean-Christophe and his team. As you said, this has been a very compressed but difficult journey, and trying to develop policy while the train is driving is always very difficult. And there is recognition for the difference in the sector in terms of what we do versus what happens in credit rating and benchmarks. And that's not by accident, but obviously is testament to the work that's been done in the preparation for this proposal. So we certainly look forward to continue our engagement with the Commission, but also with the co-legislators as this proposal makes its way through. Thank you.
Thanks very much, Neil. And I see a few questions are coming in. I will bring them into in the Q&A. Just feel free to mention who you are. You don't need to be shy in this group by being anonymous. You can communicate who you are. But with that, I pass over to you, Dennis. In a way, all of this is being designed so that you have access to more credible third-party information in making your ESG decisions. And be interested whether you, as one of the potential users of this, feel reassured by the proposal, whether it's achieving on the basis of the draft what you would like to see, or where you think there might be scope for further considerations.
Yeah, so first of all, I must echo what Neil said. Jean-Christophe, really good work. DWS, as described, is a user of ESG ratings. We buy ratings from different data vendors, so we are definitely in the situation that we must handle them for our investment, for the way how we disclose ESG characteristics to our clients. And that's a very important point. We are the intermediary between a rating provider and the client has an expectation to understand what's in there. So we need a very transparent approach, and the demand for ratings increased dramatically over the last couple of years. So when you go to the different steps, of course, it is important to see the methodology, and Neil said that he believes that the methodology is well enough described, but here we observe that even for pie disclosure and other things, even if there's a definition of the EU Commission, what we must use there, it is different, and we must understand the difference. I'm totally agreeing that this open methodology for rating agencies is very important. I strongly believe that an efficient capital market needs different methodologies, different approaches to generate information, that we will find at the end the best outcome by using them. That's also the reason why most of the asset managers are using a multi-vendor approach. But I can really say it's more and more important for us. It's even a time perspective, because we generate disclosure, new disclosure for every fund. So it must be easily accessible by us. It must be easily to transport into our tools, that we can have a direct reference to the methodology of ratings. Because one thing changed over the last couple of years, even due to the ESMA guidelines and other recommendations. We are using more and more raw data information in our filters. It's not so important to use structured ratings as in the past. An example is the quality rating that most vendors are providing, but more and more is really to controversial weapons, to controversial sectors. So really a direct information, and even there, it's important to understand what is the definition, maybe between the different value change of a signal. Let's use coal exposure, its production, its servicing, its transportation, its processing. We need this, and we must really be in a position to make this transparent to our clients and investors.
Thank you very much. You've raised a few interesting questions in my mind there, Dennis, that we might come back to. And maybe I start with this because it's also being picked up in one of the questions that we got, which is, I'm paraphrasing a bit the question there, but it's kind of the nature of the scope, Jean-Christophe, of this proposal is in a way, not just in a way, it's broader than certainly the credit rating agency proposal and broader than the benchmark regulation, that it does cover not just ratings that involve some form of judgment, and there you have, of course, inherently conflict of interests, governance issues, and so on. And it's an ongoing process involving individuals, but you also include scores, where if I were to put it very simply, somebody has to come up with a methodology at the beginning and an algorithm, but once it's in place, it kind of just pulls in the relevant data and gives you kind of a scoring of different companies or different funds against each other. So it's quite a different business model, and it's much broader constituency. In thinking through the scope of this proposal, how have you approached this issue? Because, you know, it's true, Niels, you're right, we knew about this proposal for a long time, but there was a long discussion right until the end whether we would have expected only judgment-based ratings to be included or also these scores. So I don't know, Jean-Christophe,
Yeah.
you can elaborate on this a little bit.
Sure. Happy to. Actually, in our mind, it's been always pretty clear that we wanted to have both in scope, because again, of the use of scores or the use rating is the same in the end by the investors. The same investors will buy from Bloomberg ESG scores to MSCI ratings and others, and they will use in the same way. What is also important is what you mentioned, that at the beginning there is a choice by the organization, by the company, by the first person that puts on the methodology in terms of what elements to factor, what are the weightings to consider, and then what are the criteria, whether it is looking again at ESG, whether it's looking at climate transition risk, whether it's looking at this or that. So there's a choice by the organization in terms of what they want. So there is no rating analysis within the process, indeed. So it is different business model. This is also why we wanted to recognize that, in the impact assessment, in the explanatory memorandum, but also in the definition of ESG ratings that speaks about ratings and score, and also for the first time introduces a definition of opinion. And I think it was important there for us to capture both scores and ratings because, again, of the use that is made by investors.
Maybe Dennis, based on this, I found that very interesting. I took note of the point that, if I paraphrase, you adopt a multi-vendor approach, which totally makes sense, but you also say that you're increasingly drawing on the underlying data because either the methodology isn't very clear or you've got certain criteria that are important to you. But when you say you adopt a multi-vendor approach, I'd be interested, how many of the, let's say, vendors that you use build in judgment elements, or how many of those are actually score-based ratings?
So that's not an easy question because we have up to 25 different ESG facets for our funds. So when you go to a climate active product, of course, you must integrate the entire PUB benchmark criteria. And then on top, there are also scores and elements that are constructed by index providers. And this is currently the way, even for active products, to track a benchmark that is structured by MSCI or with ISS ESG data. So definitely the controversial sectors part is currently the most valuable one, plus norms. This is so important due to the regulation, due to the good governance, due to the do not significant harm calculation, that I believe 80% are direct information, where we also believe it is more important to align company disclosure with what we use in our investments. So that's important. And 20% are constructed ratings that are dependent on the methodology. But even for the raw data information, the definition is not always equal. So when you look at revenue share that is mapped to an SDG, it's not equal for a vendor because the mapping is different. So it's crucial to see the methodology, even the mapping, that's getting better. So Neil also mentioned that this is an evolving market. We have more tools, we are faster in adapting them. But yeah, this is currently the ratio, I believe, 80 to 20%.
Let's be provocative here. Based on what you described, which in a way doesn't surprise me, do you see that this piece of legislation is actually needed? In the sense of, if this is a subset of your kind of vendors, plus you do your own assessments, and you can see the underlying methodology, it's very different. The point is, it's very different to the credit rating agency market. For example, we've got 2 or 3 or 4 main rating agencies, or the benchmark market where you might have just one benchmark administrator for the market. Here we've got a much more diverse approach and use of ESG ratings. I'm not saying that Jean-Christophe didn't do a good job, but that's what I'm saying provocatively. Do you feel this piece of legislation is needed?
Definitely. So we touched one point, that is the methodology point. And even here, it is, as I said, not the question of aligning methodologies, but in the way how to display and describe these methodology. It is so important to have here a clear framework. Secondly, the competitive of the market of rating agencies. Jean-Christophe said there are more than 60 different vendors, but it's very concentrated on some of them. So here, important to give them also the possibility to be part of that market. So I think it is necessary. DWS joined the German association BVI in answering the consultation, and there we made a huge effort to give you feedback on all the different points. And so it's a starting point. Not very often that investment firms are asking for regulation on different things, but here the uncertainty and really the demand of a clarity to end investors, and that's currently the most challenging part, because we have a huge information asymmetric between the entire industry of rating vendors, of investment companies, and the client. We need here golden sources and clear approaches to make this at the end readable. And so I not went through all the slide Word document, but most of it, and I really appreciate this, more on the methodology part, more on the way how competitive it is for all the vendors, and clearly also something that the entities are separated is a clear advance for us, because so we use it in the same way as index providers and other market participants.
Raise an interesting point, because, and I bring it back to try and bring in one of the questions again, which is on the third country regime. And when we looked at what was happening in many of the other jurisdictions, the focus is exactly, Dennis, as you say, on the quality of the methodology and the transparency of the methodology. It's at the heart, I think, of the principle, of credibility of the sector. But many of the other third country jurisdictions are currently, and I should say currently because the EU is again ahead of the game, not going for a fully regulated licensing regime, which might or might not cause questions or issues around the third country regime. I don't know, Neil, whether you want to comment on that. Maybe one last observation for me, but I've noticed, Jean-Christophe, the third country regime is a bit different to the one in the benchmark regulation. I'm still trying to map the two. So you've evolved it a little bit, but I still find it interesting, but that's as an observer, and you can respond to that. I find it interesting that you've reintroduced a registration regime, just as your colleagues in securities markets are considering and having an expert meeting tomorrow to whether to shelve that bit of the third country regime in the benchmark regulation. But maybe before I let you respond to that, Jean-Christophe, first, Neil, as a global provider and seeing global trends, how do you consider the third country regime? How useful is it? Because the question was, why go through ESMA? Why not allow third country ratings to be used freely within the EU?
Yeah, thanks, Nick. I mean, look, there's no easy answer to this because I totally understand where the Commission is coming from in terms of if ratings are to be used in the EU, you need to have some level of protection about what those ratings are, right? I mean, otherwise it's the Wild West, and nobody. It sort of makes no sense, and especially for us as a provider who will register in the EU, it's only fair that there's a level playing field again. Going back to that point. But then on the other hand, the options that are available, whether it's equivalent endorsements, come with their own issues, whether it's, who is deemed to be equivalent, which is always going to be a challenge, just as you said, Nick, because of the fact that other jurisdictions either are not choosing to go down a regulatory pathway intentionally or are going to take longer to get there. And so, the Commission has built in, I think, again, very helpfully, the fact that, compliance with IOSCO recommendations as an option for consideration for providers, at least to align themselves with that global standard, which I think is new and is something that will help, I think, in getting us over that hurdle. But it is going to be challenging. I mean, there's no doubt about this. I think, it's going to, again, there's going to be a lot of uncertainty, exactly like we have now in the benchmark space about what's in and what's out. And it's going to be a case of implementation of that, that regime. We know it, as you say, doesn't work effectively. The question is going to be, how are we going to encourage and make sure that EU users of ratings have access to ratings that meet the same standard, whether that's something that could be done even, let's say, regardless of the fact that there's an international regulatory standard out there, but at least the EU provider can confirm or in some way guarantee that its ratings are meeting those standards that are equivalent in the EU, that those ratings can continue to be used. Because I think the reliance on regulatory frameworks or others is what causes the challenges, as opposed to you're an EU provider, you're responsible for how these ratings are used. And so you ensure that they meet the same standards, regardless of where they're produced, where they're sort of distributed from, but if they're available for use, that they meet those standards. So I think maybe that's the weighting that we're going to need more so in this type of environment where we're not going to have that regulatory framework, and that ESMA, as the enforcer of this third country regime, can place more confidence on what the provider that's registered with them is certifying in terms of those ratings, in terms of how they're produced and how they can be used in the EU.
Thank you. And I think the interesting question would be the sanctioning regime, because a bit like on the benchmark regulation, it depends on the financial institutions based in Europe where they want a third country rating. It's not the rating provider in the third country voluntarily providing the service. So it's also a bit of a chicken and an egg problem to, when does a rating provider know, and a rating provider from Australia know that they have to register with ESMA? But maybe throw that in as a second question to you, Jean-Christophe. So one, the registration regime, and linked to that kind of that flow of information that might or might not be required.
Yeah, maybe I will start by saying that I think a lot of the points that Neil has made now is also the logic behind our intervention on the third country regime is to ensure that everyone abides by the same rule. I think that this is really important. When ratings are provided in the Union, then everyone needs to abide by the same rule. And there needs to be some functioning avenues for third country providers to continue again to offer the services, again, because of the nature of the market, the larger one being outside the Union. And we are not saying you need to be here also. So I think there is a lot of different avenues. We have fine-tuned the requirements also compared to what is in the credit rating agency. For example, credit rating agency doesn't have recognition regime at all. It doesn't have references to IOSCO by nature. But here we have the recognition regime on top of it, coming from the benchmark regulation. We have tried also again to fine-tune here and there the elements, and we think and we hope that the third country regime will work. We know still that a lot of jurisdictions are working towards regulatory framework in the UK, like in India. There is a lot of code of conduct as well that are being implemented, and some, by the nature of their code of conduct, are not just industry-based, but are code of conduct that are enshrined in national law or referred and reflected to. So there is a way also to play around that. And again, as also mentioned by Neil, the IOSCO recommendations are a strong link point there in order to ensure that the regime would work. So, I mean, we are very much looking forward to hear from stakeholders, from those providers that are located outside the union on this third country regime, and we will see during the negotiations how things unfold.
Thanks. And just to clarify, I think it was really more about the question of proportionality rather than the rationale of the framework itself. But as you say, we'll see how that goes. And yes, I think we should also commend you not just on the work, but also on the effort to align with the IOSCO standards to the largest extent possible, and that being a basis for the international cooperation. Time is flying very fast. And although I would have many more questions, I think we need to leave it here and give people a chance to have a bite to eat. I would like to thank you, Dennis, Neil, and most importantly, Jean-Christophe, for spending the time with us. And again, congratulations for the work done so far, and good luck with the legislative process. And yes, I think we'll have many more conversations on this file over the next, hopefully from your perspective, 9 months, try and get it over the line, or maximum a year. Good luck with that.